Well, Friday's gains have helped Dalal Street turn positive for the week. The Nifty and the Sensex have snapped the two-week losing streak, regaining half of last week's losses. Over the next 30 minutes, we decode this week's market action, tell you why tech stocks are still outperforming in this market, and also put the spotlight on the big debate around the consumption slowdown. Hello and welcome to Editors Roundtable. I'm Surabhi Upadhyay, and with me are Nigel D'Souza and Prashant Nair as always. And joining us in the studios this afternoon is Rahul Arora, CEO of Nirmal Bang Institutional Equities. Gentlemen, great to be here with all of you, and there's plenty to discuss today.
You know, generally there are four of us and one guest, Rahul, so you have to make up for two. Two of us.
I'll try my best.
But I think markets came back in style, right?
Yeah.
And I think when they're back, they're back.
Yeah.
I don't know if they're really back.
We'll know on Monday, once the political stuff is out of the way.
Yeah, so tomorrow, Saturday, we'll have the Maharashtra elections, etc. But I think it was getting to a point where, I mean, this morning, Friday morning, for example, this morning, dollar was up back above 107. But generally, things had... It was looking like the market wanted to bounce a little bit. We finally got that bounce.
Yeah.
But there's still too many variables, too many balls up in the air, especially from the global side, which I think make it harder to say whether this is it. I think flows and positioning, etc., we'll get a better sense when we get those numbers later today, and we'll have to pick up from there.
I guess for Nigel, it was markets along with cricket.
Absolutely.
And the momentum was, I don't know, where was it stronger, in the market or on the field?
Both, actually. You know, the boys are doing well out there. So hopefully, things end up well on the cricket ground as well as for the markets. But Rahul, how are you feeling? The last quarter's earnings numbers were I don't know how many quarters in terms of it was the biggest disappointment we've seen in the last 6 or the 8 quarters or whatever. But now looking ahead, if I was looking at the capex spend from the government, the first 5 months, I think it was around 3 trillion. And in the month of September itself, it was 1 trillion. And the benefits of that will flow through in the second half of the year. So we're counting on that big booster shot to help earnings as well. What is your sense in the markets? We went down to around 23,200. We ended closer to around 24,000 odd. How do you think you're placed?
So first off, thank you for having me on the show. And just to start off on a lighter note, you brought back some childhood memories when you said the boys played well. It was almost felt like Azhar was speaking.
The boys really.
Oh,
no.
God, you remind us how old we've become.
No, but that's just on a lighter note. But I think you raise a valid point, Nigel. I think before we went into the result season, when the Nifty was at about 26,500, I think most of the stocks in our coverage where valuations had become excessive were trading anywhere around 1.5 to 2.5 standard deviation over mean. In fact, if you looked at most of these sectors, whether they were consumer durables, electricals, defense, chemicals, the price to earnings multiples were almost 2x on the return on capital employed. Now, these things are generally not sustainable. To your point about whether government capex can sort of push, things going forward. So if you look at the quintessential formula of GDP, which is C plus I plus G plus X minus M, the X and M, I think, will evolve over a period of time because now Donald Trump is coming in and we don't know how the tariff situation will work. Yeah. And China has just issued a stimulus, to its own economy not too long back. So, how the export-import works, we'll have to see. Now you're left with C, I, and G. Consumption, as Surabhi mentioned, and even as we saw in the results, has not been too good. In fact, we just had our conference, about 10 days back at Taj Santa Cruz, and we had a lot of representation from the FMCG sector, and nobody was sounding extremely gung-ho. So you're basically down to I and G, which are the two engines on which you're looking to support. I think as far as corporate India's capex is concerned, Nigel, a lot of that was announced post-COVID, because if you see one of the biggest things that came out of COVID was the deleveraging of balance sheet of corporate India, and a lot of capex was announced. I think we're sort of at the top end of corporate India announcing capex. So it basically falls back to the central and the state governments to announce that. Now, obviously, a lot of these may be linked to state elections, but I think my sense is we need to moderate our growth expectations dramatically on earnings, because if you look at corporate India by and large over a period of time, the earnings growth has been driven by margin expansion or by deleveraging of balance sheet. So either you delevered balance sheet, interest costs came down, EPS went up, or you expanded your margins and your EPS went up. I think now the challenge is going to be top line driven from here, and I think that's why it's been a little more severe in this result season than it has been in many others, even though this has, as you rightly pointed out, been one of the worst result seasons in recent memories. But I think from here, the onus is purely going to be on top line growth. And you may find that companies that are growing at 13-15% get disproportionately higher valuations as opposed to companies that will probably grow at, say, between 5 to 10%. That's the way I look at the next 2 years, because I don't think there is too much by way of deleveraging or margin expansion that can happen from here on.
All right, just
but
one.
just to follow up.
Can I just summarize
please,
the
please.
markets?
Oh, yes.
Let's
before
do
we go
that.
in?
Let's do that
By
first.
the way, heavy stuff. When you're talking about how Nigel reminded you of Azhar, you reminded me of my economics professor, of the GDP formula and whatnot. I mean, anyway, very near term, right? I mean, just a few things that I think markets will pay attention to. One, of course, is the Maharashtra elections. And I think the only reason the Maharashtra elections will matter if the exit polls are wrong. And that's the worry, right? I mean, the exit polls have showed something. If they are, if the actual results are in line, I think, today's rally stays and maybe we're able to build on it. If they are not, then of course Monday becomes a bit more tricky, at least in the very near term. Headlines, Russia, Ukraine. You saw what happened this week on Tuesday when the market were cruising along nicely and these headlines came, markets fell. I think they're still very relevant and what happens. Strength in the dollar, past 107. I mean, it's classic. Dollar higher, it's essentially negative for emerging markets and the dollar is heading higher. I think over the weekend, will we get a US Treasury Secretary announcement? The last we heard is a gentleman called Kevin Warsh is the leading candidate for the next US Treasury Secretary. Why is that important? He, by his own admission, is openly hostile to what he calls those who disfavor US interests. So, I mean, generally a sort of hawkish gentleman in that respect. And by the way, he's also been tapped, these are reports, to be the next Fed chair after Powell retires in 2026. So that's the other one. By the way, one thing which went unnoticed on Friday was that China was down 3%. I think we didn't talk about that at all. And this is interesting. The Texas governor has directed Texas state businesses and state agencies to divest their portfolios out of China. Right? I mean, I think that is that's a indication. And I mean, if this flows moving from one to the other, that is India and China. I mean, I think this is one signal, and this is all happening in the build-up to, of course, the 20th of January when the Trump presidency will be inaugurated. And I'll just leave you with some levels here for both the Nifty and the Bank Nifty. It's the 20-day moving average. Simply put, for the Nifty, it's 24,030. For the Nifty Bank, that level comes in at about 51,298. So, I mean, that's, as they say, the Lakshman Rekha between, at least in the very near term, and it matters. Let's see if we've got it in us for the market in the indices to sort of in this leg higher across these levels, so as to speak. I'm not mentioning the Adani related news flow, and we'll talk maybe more about that with Rahul and whether there are any implications thereof. Surabhi.
Yeah, absolutely. I mean, there's plenty to digest for the market. But Rahul, what I was trying to ask is that one thing that we've heard almost from all managements in this earnings season, wherever they've not had a great quarter, is that second half is going to be better. You hear it from consumer companies, you hear it from cement companies, you hear it from every company. Do you believe second half will indeed be much better for earnings recovery?
It's a tough call to take, and I'll tell you why from a consumption standpoint. I think because you had a general election earlier this year, and I think if that was not able to give you a high single digit sort of volume growth, I don't see how it's going to happen. Obviously, for a lot of consumer discretionary companies, this quarter was good. So air conditioners were good, so on and so forth. I think, that's a case-to-case sort of basis. I think, we recently interacted with a very large electronics retailer who was talking about iPhones and television selling, but unfortunately, there's no direct way to play it through the stock market. So my sense is that consumer discretionary will still continue to perform consumer staples. As far as cement is concerned, it's a direct proxy to the infra spending that's going to be happening. So the point Nigel was raising a little earlier about government spending happening, this is a second order derivative. But I think if you take a 10-year sort of, a chart of cement volume growth, it averages about 6-8%. And I think a lot of the delta is, sort of hinged on pricing. Now, I don't know how much pricing power these companies are going to have. So it's all right to say the second half is going to be better. But like I said, I think the visibility of that is not so strong today in some of these sectors as it probably was anticipated to be, say, 6 months.
Okay. Since you brought up consumer, and I just have a follow-up question before that, just presenting some data points and some commentary that I picked up across different brokerages and management commentary as well. Now, what is the consumer up to and what are the trends telling us? So it's very divergent between FMCG, what's happening with autos, and let's say what's happening with consumer durables. Now, on FMCG, we know the numbers have been bad across the board. So some highlights from what CLSA is saying in its latest commentary. They're saying that this has been the biggest earnings miss in recent memory. Of course, everybody is noticing the rapid worsening of demand, particularly in urban metro centers, tier 1 cities. And the other trend is the rising GOV numbers when it comes to quick commerce. Quick commerce has taken off in a big way, but that also means disruption in the delivery channel. I'll come back to that. Just some numbers. So Motilal Oswal, I was looking at the set of consumer companies they cover. That's 19 companies in all. Sales are up 6.5%. EBITDA is nearly flat, just about 1% growth. And the profit is actually down marginally, 0.2% lower. Now, their rationale behind the slowdown, adverse weather conditions, lots of flooding, extra monsoon, etc., persistent inflation, again, urban demand issues, and then they're also noting this quick commerce element and what that is doing. Blue Star this morning, however, look at what Blue Star is saying. This is a company that's saying that we've grown 30% in the festive season. There is no slowdown in AC sales. Look at what the auto numbers are saying. Initially, when we got into the festive season, there was a lot of worry on demand. But finally, if you look at FADA numbers, festive season this year over last year, it's not that bad. You're clocking about 12% growth in terms of volume. So mixed trends, trying to understand the mind of the consumer right now. So to go back to this question, Rahul, and you've tracked this space really closely, I want to go to the question on quick commerce. And some of what, let's say, what Dabur said, and I don't know what's happening with Honasa. That was another major casualty this season. How much of it can we blame to strategy changes because of quick commerce, and how much is real demand concern, and is it going to be a prolonged concern?
I think this calls for a much bigger discussion, because my sense is that India as a consumption basket is actually skipping some levels of consumption, the way I look at it. And I think if you're looking at, say, let's talk about disposable income and how much of that may actually be even coming into the stock markets from tier 3, tier 4, tier 5 cities. That which was otherwise going into consumer staples or otherwise, if this is coming into or going into far more productive assets and you're making money, you're probably skipping levels of consumption, and which is why you're seeing. Now, that doesn't mean that consumer discretionary will keep doing well as well. I mean, I'm sure you guys would have seen the recent Indian Hotels analyst meet. Puneet is actually talking about doubling his turnover over the next 6 to 7 years. That's about a 13-14% CAGR. That's all right. It sounds all right for a headline, doubling of turnover, but it's a 13-14%. So I think somewhere across the board, obviously quick commerce has made a dent. It has got a lot of unorganized people into the organized foray. They're able to reach out. Distribution as a moat has been destroyed completely, and I think that's where, if a Lever or a Colgate are finding it difficult for volume growth. So I think that the entire, sort of thought process earlier of having 6 million or 8 million or 10 million out, distribution touch points, that's gone out of the window.
Yeah.
I think it could, on certain aspects, it could be a little more relevant, like say P&G, because of the product that they cater to, but otherwise, I don't think that. I just think it's a change in consumption pattern as opposed to another mode of delivery coming in. And I'll give you an example. Domino's even today does more sales on the Domino's app than it does through Swiggy and Zomato. 98% or 99% of the orders are through the Domino's app. So something like that where you've already established, competition cannot come and break it. But yeah, I can understand, from the point of view of the point here, Surabhi, is that people are not buying soap shampoos.
That's what I'm saying.
That is the issue.
It's not are a secondary matter,
exactly.
whether it's
so
online or direct or quick commerce.
Absolutely,
or whatever.
and it could be that people are moving from showering with the box soaps to shower gels or things. So we may be skipping levels of consumption, and maybe the traditional consumer companies are not equipped to deliver that. And this could be true of IT services as well. I mean, just look at what Tier 2 IT companies are doing, the Persistences of the world, the Coforges, and so on and so forth, the kind of growth rates they have, vis-a-vis an Infi, TCS, Wipro, HCL Tech Mahindra, these guys are growing in that 5-8% range. These guys are going at a different tangent altogether. So it's about how you're innovating, new companies coming in, what is your product offering, and are you appealing to the next-gen customer?
Yeah.
That, I think, is the most important thing.
Absolutely. Speaking of IT, Nigel here has been looking at some numbers there.
Well, that's right. DAM Capital, they put out a note and they said they believe that now it's time to go overweight on the tech space. And I'm putting it as it appears the bulls, well, now they're getting a little bit more tech savvy, or let's call them the tech savvy bulls. And the reason I'm talking about it is, if you look at it in the last 1 year or so, well, those lines are pretty much going in sync, for majority of the time. But in the last 1 month or so, suddenly tech has broken away. And in the last 1 month, the tech index is up close to around 6.5%, while the Nifty is down close to around a percent or thereabouts. So what has changed, in terms of why have we seen such a big move? Let's pull up first the last couple of years. In FY24, if you're looking at the Nifty 50 earnings growth, well, that was pretty good. And the tech space, the Nifty IT index, if you look at the Nifty IT index, the growth out there was close to around 6%. We should actually pull up the previous plate up for you on the screen, because in FY24, the tech space actually was lagging in comparison to what the Nifty earnings growth was. So earnings growth comes up for you. But in the next couple of years, actually, the IT index, well, the earnings growth there could be better than what the Nifty 50 will do. So, DAM Capital has put it out at close to around 14%. Why is that? They're expecting better revenue growth, and also they're expecting the rupee to be relatively weaker, which they believe will be good for earnings. Now, the Trump trade. Trump is reportedly good for tech. That's what the DAM Capital note as well mentions. And they have mentioned 3 big points out here. One is in terms of the rupee depreciation. They say that in the last term, the rupee depreciated by nearly around 4% on an average every year, in his last tenure. And they have put up a plate as well, where they say that, in fact, every percentage or point in rupee depreciation will actually be good for earnings as well. So that's point number 1. Point number 2 is he's been talking about potential reduction in the US corporate taxes, which in turn could result in higher spending. And talking about spending, we have seen a lot of focus on spending on equipment. Now they believe that there'll be a lot of spending in the services sector, which in turn will be good for Indian IT companies as well. Moving to growth then, growth for the tier 1 companies, well, it's gradually been in that 3 to around 4% odd. But now the expectations in the next couple of years, things will pick up as the rupee depreciates. You're expecting tech spends as well to go up. So that's what will work in their favor. And just to give you a comparative study of the previous 2 years, the way some of these tech companies were growing and how they're expected to grow. As you can see, some of them were growing. They'll grow at a faster clip. Some of them were degrowing. They, in fact, will return back to growth. And some of them that were growing, like Persistent was growing at around 16%, it'll continue to keep in step. So growth in the next couple of years will be better than what we saw in the last few years. And also, if you're looking at valuations, and some of them should come up for you on the screen, the better the growth engine, obviously you get a better multiple. Stocks like Persistent are trading at a bit of a premium, while some of these stocks are in that vicinity of around 19 to around 22%. So the few points to note from here on is tech has started outperforming. The rupee could be, relatively weaker, and also growth will come back. So let's see how this plays out. Rahul, how are you all placed on tech-related names? The IT index itself has suddenly come back in a big way. Do you think it's running ahead of itself, or do you think good reason? As I said, earnings will be better than what the Nifty 50 earnings is likely to be after trailing it in the last couple of years.
So I think one of the important things, Nigel, to also note is that there's a technical factor here. I think if you look at the IT index over the last 2 years, it has massively underperformed the Nifty. I think, if I'm not mistaken, 2022 would have been about a 25-30% underperformance to the index, and last year would have been about a 10-15%. So there would have been a technical underweight stance. Now, obviously, as your chart rightly showed, this is sort of coinciding with the US rate cut cycle as well. And now Trump coming in, people think rate cuts will probably get a little more accentuated. You may not have too many 50s, but you probably have maybe 25s. Since you're on the subject of tech, TCS was one of the companies that we hosted at our conference just about 10 days back. They were very bullish on US discretionary spending. And they said these rate cuts will actually spur, I think the word they used was huge modernization programs in the BFSI sector in the United States. So I think if this happens, and so going back to the point that I was making with Surabhi earlier, I think for mature consumer and IT services companies in India, I think 5% is your pivot growth.
Yeah.
In good years, it could probably head to 7-9%. In bad years, it probably comes down to about 1 to 3%. If you're looking at, say, an 7-8-9% kind of growth, coupled with rupee depreciation that you're talking about, and some benefits on subcontracting charges, which gives you a little bit of margin expansion. On that night, and these are cash-rich companies, they'll earn interest income on their investments any which way. So if you look at, say, a 13, 14, 15% kind of earnings growth, this sector will continue to outperform, is my sense. So if you get into within striking distance of a double-digit top-line growth, 8-9%, this sector, I think, will continue to outperform because of the technical factor that I said, where it was the underperformance under ownership, and the fact that now there is genuine conversation about spending at US banks and discretionary spending,
Yes.
which along with some of the margin levers I gave you, which could probably result in a 13, 14, 15% earnings growth, this could hold up valuations. Can this significantly read it from here? I don't know. But valuations can certainly hold up in technology.
You know, the one is, of course, IT stocks. The other is, I was thinking about consumption. I don't know if you guys saw this, you know, there's a gentleman called James O'Brien. He's professor of computer science at UC Berkeley. He wrote on LinkedIn, I just want to read this, and maybe our viewers can go and check it out. He essentially saying that previously a Berkeley computer science graduate, even if not a top student, would receive multiple appealing job offers in terms of work type, location, salary, and employer. However, outstanding students, like those with 4.0 in major GPA, are now contacting me worried because they have zero offers. I suspect this trend is irreversible and likely part of a broader trend impacting almost every employment sector. Not so much a comment on IT services sector, but I mean, if this is a computer science professor at UC Berkeley, I'm just thinking in terms of, it's just a thought. What happens to a large part of the premium consumption in this country over the last 20 years has been supported by IT work, right? I mean, IT services and IT services employees. It's nothing immediate, but I think it's something which will increasingly come into focus. And I think the connection here, of course, is AI.
I was just going to say, I think it's also about the curriculum, Prashant. I think it obviously branches out into a much bigger discussion about, you know, what you need to be teaching. I think if you're hitting a 4.0 GPA in something that is being taught, but that's not what the market requirement is, it could be very different. I think, you know, it's...
I think, I don't remember the numbers now, but we produce a lot of computer science graduates in India every year. You know,
Don't hit a 4.0 GPA.
You know,
or on a side tangent.
3.5, you should be okay.
I'll tell you one of the things, since you raised it. I had spoken to the CEO of a tech company, one of the largest tech companies in India a few years back, when they had started making acquisitions. And you'll probably know which one I'm talking about, but there were a few acquisitions between 50 to 150 to $200 million. And I asked him, I was like, you know, you've made 3 or 4 acquisitions in a matter of 2 years. What's going on? He's like, it's very difficult to reskill people who are north of 40 because their education is in one way. The guys who are 25, 30, and in Silicon Valley, you'll be surprised to know how many companies are coming up with very significant valuations of people who are in that age group of 20 to 25, who are probably just inventing something, selling it out, and these guys are making, you know, bigger bucks on it. And these guys are just taking home the cash up front.
I dare say it's a damning indictment for all of us. Maybe
That's what I'm saying. I think we need to take a break because this conversation is making me very, very glum and making me feel extremely old and outdated.
We'll come back and discuss it. We've been really told to take a break, so let's do that. Rahul, of course, is with us. Perhaps we'll have some time on the other side. Stay with us.
We discussed, and all of them did well. What's your view on the stocks?
So I think, Nigel, these are obviously the three crown jewels of that group. And I think obviously ACC and Ambuja, even before they took over, these are very cash-rich companies. So
Yes.
there's nothing wrong with the operations. They've been existing in the business long before, some of these groups even came into existence. So there's no issue as far as the business is concerned. It goes back to what kind of volume growth and so on and so forth. The problem here is when something like this happens is this issue of governance premium and discount.
So don't buy.
So no, I'm not saying don't buy. I'm just saying that as a fund manager today, if I'm looking at large cap cement, I have predominantly three options. I have Ultratech, this group, ACC, Ambuja combined at some stage, and Shree Cement, right? Shree's valuations are not that compelling at this point in time, so it's either Ultratech or this. And you would see, I think the day the news came out and the market was down, Ultratech was up 2%.
Yes.
So I think at this point in time, if you're somebody who can take that 2-3 year view and look at value, it's not a bad time to be looking at Ambuja. But don't expect miracles to happen in the next 3-6 months. If that's your time horizon, I'd probably say you're still safer off being with Ultratech than with this.
But if you have a longer term horizon,
I think ACC Ambuja, because there is genuine cash on the books, there are genuine assets there. So also for Adani Ports, I think if you have a slightly longer term horizon, certainly buy into these three. The others we don't track and have no view on the other Adani Group stocks.
got it. Okay.
Okay, all right. That's plenty of food for thought. Rahul, thank you very much for joining. And we're going to take you up one day on that larger, longer discussion on consumer because it's a very interesting aspect. For now, it's a wrap on this edition of Editors Roundtable. Thank you very much for being with us. More news and updates coming up on the other side.